Welcome to TQ Talks, where taxes meet planning. Here's your host, Craig White.
Welcome back to another episode of TQ Talks. Happy that you can join us today. We've been going over for the last several weeks business information, whether it be estimated taxes or payment plans, whatever the case is. This week we are on the estimated taxes discussion, right? Last week I think we went over extensions and trying to help business owners to understand what the purpose of those were. And we started to talk about or mentioned, making estimated payments, and, this is what we're going to do. So in this episode, I wanted to address the understanding that business owners do not have. When we first started business, and Sebastian says it all the time, he calls us the first gen business owners. There's a lot of nuances that I think we, and of course a lot of people have. One of the things are estimated taxes and the surprise bill that shows up when you're a business owner, right? When you're a W-2 employee, things are taken out for you. You're not thinking about it. You're just complaining and saying, oh my God, I worked this many hours and look what the thing got taken out and blah, blah, blah. And we understand. When you're a business owner, all the money is usually given to you up front, and the IRS is having an expectation that you are paying attention to everything that has to be done, and one of those is paying taxes, right? And unfortunately, if you've ever been hit with a surprise tax bill or wondered why the IRS expects so much money from you before you file, because sometimes that's the whole thing, this whole estimated tax thing. Why am I estimating taxes? I don't even know what the heck I'm making. We're going to break that down. We're going to help you to understand why this is a pain point for business owners, especially when you don't understand the concept of estimated taxes and why these people called the IRS are taking your money. So let's get into it, man. And let's start with the why. The first thing you have to understand is that the tax system in the U.S. is a pay-as-you-go system, right? It's pay-as-you-go. That means the IRS is expecting taxes to be paid as the income comes in. Again, that's referring, right, to the W-2 owners. That's an easy way for you to understand it. It's not an all-at-once thing or not once a big lump sum when you file. It is as the income is being earned, money is being taken out, and it's put to Medicare and Social Security and federal taxes and all the other stuff. So estimated taxes exist to keep you current during the year. That's the whole point of you paying those estimated taxes. And again, estimated taxes generally apply when taxes aren't being withheld automatically. Again, referring to W-2ers, you guys get it. You're seeing it automatically come out. For business owners, it is not automatically come out. So we're the ones that are expected to be making these estimated payments. So business owners, self-employed individuals, as we call it, gig workers, right? Partners, S corporations, shareholders, anyone without W-2 income or investment or pass-through income, they are expected to be making quarterly payments to keep themselves current, right? That's just the bottom line. If no one was withholding taxes for you, then the IRS is expecting for you to do it yourself. Estimated taxes are quarterly payments throughout the year. For the IRS, they usually list these things online. You can Google it. It's not a big deal. It's not random. It's not optional, by the way. It's an expectation by them. And it's based on the income. And I'm going to go back and tell you guys later on when these quarterly payments are due. But anyway, the quarterly payments, as I said before, they're not random. It's not we're going to pull a number out the sky. And it theoretically is not optional either. This is something the IRS is wanting you to do, which is why when you file your taxes, if you owe too much, you'll get an underpayment penalty, right? If you owe more than $1,000 at the time you file, they'll say, hey, hold on, slap on wrist. You should have been paying us throughout the year with those estimated tax payments, and you did not, Craig. So we're going to penalize you for that, right? And Those estimated payments are based on your expected income, right? Not income you know you're going to get. It's expected income and expected tax liability. I'm going to break that down for you later on in the podcast. But again, the dates that are these estimated payments are due, it's the same every year. It's April, it's June, it's September, and the January of the following year. And usually it's the 15th of each of those, by the way, but you could look that up. But either way, it's the January 15th of the following year. So again, they're called estimated tax payments because they're based on projections, not final numbers. You don't know exactly what you're going to be paying, all right? You have no idea what you're going to be earning, so there's no way you could say, oh, well, I'm going to give this amount. It's an estimate. That's all it's supposed to be. And here's, most business owners struggle with estimated taxes because their income fluctuates, right? Cash flow is inconsistent. We have great years. Of course, we're a tax planning company that leads us into tax preparation. So like most tax prep businesses, the heaviest flow for our business is going to be February, or really end of January, but February, March, and April. That's what it's going to be. Thank God we are 365, so we continue to run, especially because we do businesses. We then have spikes again in July, August, September, that kind of stuff, right? October, it keeps going for us. But there is a heavier time frame. The bottom line with Patrick shows our income and goes over all the stuff with me. We see the spikes. We see the inconsistency of cash flow. So making estimated payments is kind of hard sometimes because you don't really know what's going on. You have to plan, or we plan too late, right? And that happens all the time. You sit there and say, okay, we made this and let's do, oh my God, we missed it, right? We missed either the date that it's due, or we were paying attention to something else and we just are behind. And that always is an error or a problem for most business owners. And honestly, you're working. Like, you're not even thinking about that crap. Let's just be clear. No one's thinking, oh my God, here comes June. It's time for my estimate. We're not thinking about estimated tax payments. Now, as you start to plan and it becomes part of your business structure, which it has for us and many of our clients, then it's just second nature, right? You know what's coming on. You got the alerts. It's time. And then you're like, okay, here we go. Let me look at my profit and loss. And we're going to get to that in this podcast as well. You're making sure that you are addressing that problem before it becomes a problem, right? You know what you have to do. You've already been over that hurdle and you're addressing it and being able to competently make estimated payments instead of panicking like you normally would do. So let's clear up some misconceptions. We hear all the time, I'll just pay at the time of filing. That's not a good idea. I can catch up. Yeah, I can catch up later. Yeah, you can, but it's going to come with penalties. Extensions fix estimated tax issues. No. If you file an extension, which we spoke about the last podcast, it does not clear things up. And let's make sure we if you missed it, I'll just do a recap. Estimated payments are made during the year and they keep you current, right? So I'm making these estimated tax payments throughout the year to make sure that I am staying abreast to what needs to be done based on what the IRS is asking me to do. An extension, right? Extension payments are made at the time of filing. They help to reduce the penalties and interest at that time. So estimated tax payments are proactive. We said this last time, and extension payments are reactive. You want to try as hard as possible to be proactive and to get things out the way, and then to minimize your reactive nature. Right? What has to be paid when the estimates come in or when you see that final tax bill should be smaller. It should be, all right, well, let me give you some of this money with this extension that I'm sending in before, if you're a corporation or a business owner, before March 15th. So that way what I have at the end is not as bad. So if the year is going well and money increases, etc., the problem is a lot of business owners keep the estimated tax payments the same. And so when the season arrives and everything is done, you have this crazy surprise bill because your balance is higher than expected. because you didn't adjust your payments based on your income increasing. And that's problematic. Again, we're back to the planning, Patrick's favorite word. You have to plan accordingly, right? There's something called a safe harbor concept, which means that the rules are designed to protect the people who pay the money into the system consistently, right? And that's what safe harbor means. They're going to reward you for being consistent. It also means they don't eliminate the tax, because it doesn't, but it does to help to reduce the penalties. So if you're consistently paying in, which is what the safe harbor concept is, then the likelihood of you being in a bad situation is minimized. It doesn't mean everything is perfect. It's just a concept that you should try to fully understand. So if you're a business owner, the honest truth is estimated taxes aren't going to go away. They're going to be here. That's part of our life. It is what it is. It's something that is expected of you, and you have to deal with it. It's not a punishment, so don't sit here and panic every time you have to write a check or send money to the government. It is what it is. And if you are running a business, it's something you should have already or should be adapting or adopting into the way your structure is. You should be already planning for those estimated tax payments for each month that it is due, every quarter that it's due. You should already be looking over your books, planning ahead. And what does that mean? It means that you should be running your profit and loss. And you should be paying from your net. That's also a big error we see. People overpay. They turn around and pay quarterly payments, estimated payments from the gross earnings before all the expenses are in. Make sure that you don't overpay, because you don't want to give Uncle Sam too much money, right? It makes no sense. So good habit is to make sure that you look through your profit and loss throughout the year. And as you get closer to those quarterly dates, you run those numbers and you're paying your estimated tax payments based on the net income, not the gross income. If your income shifts, you need to shift your payments up or down, all right? And make sure you pay attention to that. Again, takeaway for this is estimated taxes aren't something to fear. It's not something for you to worry about, something for you to panic. There's something for you to manage as a business owner, and it's there to help you. Next episode, we're going to talk about cash flow planning, which should probably help you to fully understand and conceptualize all the things we've been talking about for the last month, and to make sure that you have your system in place for your business so that it runs smoothly. That's all we have for TQ Talks today. Thank you again for listening. Any questions, give us a call, 800-413-1456. Like, follow, share, all that good stuff, and we'll talk to you on the flip side. Later, guys.
Thank you for listening to TQ Talks. If you enjoyed the show, please rate and recommend on iTunes, SoundCloud, or wherever you get your podcasts. You can also get more information at tqfinancials.com.